Welcome back. Good start to the week. Wanted to touch base on a couple of things. First, I do have Google and Microsoft on the website with deep dives. So I want to take a look at both those investments, GOOY, MSFO, how those have performed since inception, also how they're set up for the week. Then I just wanted to touch base quick on YieldMax in general, how the funds are structured. I've seen a lot of dialogue online about how these things don't keep up with the underlying equity. And then kind of like a double whammy, when the market falls, they also fall, which can be true, but I want to take a look at some of them, specifically how they compare when their underlying equity has fallen a lot. Because a lot of people that are saying that these things fall when they fall, which they do, but I guess depending on how the underlying equity trades, YieldMax can save you some downside. Jumping into that here quick, if we go to the YieldMax overview, you can filter based on this total return percent column. By doing that, you see your top funds here, Misty, NVIDIA, PLTY, Coney, GOOY, all returning total return, which includes the return on the ETF plus the cumulative dividend. As terms of a percent, we can see Misty topping at 187%. Then we also got some other ones, three in total over 100%. Then several kind of in the 40 to 50% increase. For a lot of these, they are underperforming the underlying equity. However, that said, one other thing I wanted to point out is you see all these funds in terms of when the inception date. The inception date for all these is, the earliest is late 2022, but most of them it's 2023 or 2024. And if we just take a look at the S&P 500 from a 2023, or let's see, late 2022 to 2023. So we started making these funds, I guess, right around here. Maybe a 5-year chart would be a better look. But right around this range, so we did not have these funds for the downturn that was 2022, but late 22 when stuff was basically hitting a bottom, that's when these funds were created. And then you can see jumping up to now, I mean, we've got more than a 50% increase in the S&P 500. So we're definitely in a bull market. Therefore, to suggest that these funds, which do cap upside for income, to suggest that these would keep up with an underlying market that's up 50%, I guess that's somewhat ridiculous that people would expect that. These are not the same instrument as owning the underlying equity. By selling the upside, you got a different instrument. You got one where you're taking income up front, but you're capping upside. Therefore, you do get income, but to think that something would keep up the underlying equity when you're like a 50% run bull market, that's somewhat crazy. These would definitely perform the best probably with the market that's increasing, but increasing at a steady rate. That said, these do need volatility to produce their returns. But if you have a volatile market, but one that's not necessarily at 50%, but maybe it's up 10, 20, 30% in that 3 year span, these things, I think it'd be surprising how close that these things might come. Of course, each of these follows an underlying equity. But that said, yeah, I just want to point out, people that expect these to keep up with the underlying equities. So if we take a look at one, for example, it's total percent that has increased a lot. So just like Netflix, for example, Netflix is, or let's go Netflix or Facebook, whichever one I find. So if we go to Facebook and we do a compare, you can see the underlying equity is doing quite a bit better than the YieldMax funds. This assumes a $2,000 starting investment. So FBY, if you were to just invest in Meta, you'd be able to turn your money into $5,157. Whereas YieldMax, non-reinvested dividends, you turn $2,000 investment to a $3,389 investment. That said, that's a good return from an inception date late 2023. So 2000 to 33, that's over a 50% return. More than that on your money. So people are saying that's a bad return for a YieldMax fund because they're comparing it to the underlying equity. When you're in a market, a generalized bull market that's up 50% in that time span that I noted. Yeah, I don't think that's a fair comparison. But then there's also people that are saying that these funds don't hedge you on downside risk. That, of course, all depends on what equity you're following, and how it's trading specifically. But if we take a look at these and we filter based on total return percentage, but we go to the bottom here. So what are the worst performing funds? We got Murny, of course. So let's take a look at Murny to see, was that a group B or C? Group B. So MRNY, based on the underlying equity of Moderna. Moderna has not been very well. We see that with this orange, or owning the underlying stock. So initiated in late 2023, $2,000 investment. You can see initially Moderna went up quite a bit, would have doubled your money. But then since then, it's been basically a terrible investment, turning $2,000 into about $618. But those who say that the YieldMax fund doesn't protect you, if you would have taken, you can see like when Moderna is going up, the MRNY, I'm going to assume non-reinvested dividends, is taking in all those distribution payments. So then even when Moderna, the stock falls, Your total return with non-reinvested dividends, $2,000 go to $1,333. So looking at it from my perspective, this did cushion you quite a bit. Those initial dividends you got, assuming you did not reinvest them or reinvested them somewhere else, not in Murney, instead of being at $618, you've got nearly double that. So it did definitely soften the blow quite a bit. The key here, though, is that it did collect these distribution payments up front early when you can see the distributions are actually pretty good. Currently, they're under 10 cents, but for a while there, they were. I guess you had 41 cents and you had $2, over $2.60, 50, over $1, 78. So these initial dividends you did capture did soften the downside blow for you, assuming non-reinvested dividends. So I guess when I've seen people say that these don't soften the downside, they definitely do. But then you got ones that, I guess, if you go back to the chart here, and we once again filter based on total percent return. I guess if you take another example, I guess take your pick here. SMCY would probably be one where maybe they're looking at this stock, the underlying, for trying to support their argument. But SMCY, if we go find that, I got to remind myself where that one is. Is that all the way? Yep, it's in Group D. So going to Group D, this one started off $5,000 investment. I don't include like the very first month, which is the reason all these points don't point. This starts at the first distribution. So it doesn't necessarily start when it was inception date, which would have all been at 5,000. It starts after the first dividend or distributions paid out. But you can see when it first paid out, following, I guess, the first distribution date, the stock went on a massive downward spiral, which pulled the YieldMax funds down with it. But since then, the stock has basically recovered. It was actually doing quite good again until it fell again. Actually, an investment in SMCY, I'm not looking at it right now, but as of the last distribution, you're basically even on your money, whereas the YieldMax funds are actually down. So in this case, the stock was flat. However, the massive downward moves clearly impeded the YieldMax fund. Basically, the worst moves you can have when you own one of these funds is you don't want volatility to the downside. That's, I guess, far exceeding what the implied volatility would suggest, because that method takes your investment down, but doesn't necessarily give you the money to recoup. But then when you get these massive upward gains that are also probably more steep than greatly more steeper, I should say, than the implied volatility would suggest. Basically, you take most of the downside, but then don't capture nearly as much as the upside. So this is a scenario where the underlying stock is about even, but the YieldMax funds are down. Let's say, what was that, like 15%, 20%, 15 to 20%. So in this case, we got an equal underlying equity. The YieldMax funds are trailing slightly. And then maybe I'll just look at one more example quick, just see how these funds that are negative, what caused them to be negative. Airbnb, looks like it's down negative 14.85%. So looks like this is a Group C. From a compare perspective, we can see an initial investment on your $2,000 in Airbnb stock on the inception date would be worth $1,684 now. So you're down on this equity overall. But you can see the YieldMax fund, you're actually down, but you're not down as much. It's a slight difference. $1,684 owning the underlying equity and $1,755 owning the YieldMax fund total return. But you can see here, definitely the Airbnb YieldMax fund, assuming no reinvested dividends, does outperform an underperforming equity. So that's another example. But I guess overall, just the topic that these YieldMax funds, assuming you don't reinvest dividends, take them to live on or reinvest them elsewhere, they can give you a slight cushion on a stock that underperforms, assuming you don't got massive volatility upwards and downwards in the stock that can make these YieldMax funds not perform. But yeah, that's just a couple thoughts I had when I was reading somebody's thought process on these. Their purpose is definitely to produce income, not necessarily keep up with the underlying equity. If you want to keep up with the underlying equity in a massive bull run where you got a market that's going up over 50% in a, let's see, like a 1, 2 plus, almost 3-year range, yeah, your best bet is definitely going to underlying equities. But for those looking for income, these are not a bad strategy. In my opinion, there is an expense ratio in the 1% range, but or even in some cases slightly above 1%. I will never say that expense ratios are good, but given like kind of the complexity of keeping one of these strategies going, I don't think it's the worst investment. It gives you you could do this yourself, but investing in something like a fund like this, it gives you some diversity or should I say, trying to think of the word, instead of just, if you're doing it yourself and you had 100 shares and you're writing calls yourself, or even if you're doing the synthetic method, it would be hard to have the number of different strike price diversity. Like, for example, I don't know if Google's a good one. Google's one I want to cover here. But if we go in depth here and take a look at the positioning, This isn't a very large fund, so they don't necessarily have as much diversity in their strike prices. But here you see you got two different strike prices that you can play around with. But if you go to one of the bigger funds, let's say like a Misty, and you take a look at their positioning amongst different strike prices, interesting. It does look like Misty has no credit spreads this month. Maybe I'll have to, let me just take a look to make sure this is updated. So of 915, it looks like all they're doing is selling. So this is interesting. I didn't know this, but it looks like for this month, Misty, they're definitely trying to take in some premium. This wasn't what I wanted to look at, but there's no credit spreads. It's all just covered calls, straight covered calls written. So if Bitcoin really runs past 355 or 352.50, I should say, we can see the Misty fund basically be flat, while MicroStrategy, the underlying, could really rocket higher. Yeah, I don't know. Looks like a big week. The team is taking the opinion that they think MicroStrategy is going to be flat for the month, for the week, or go down, because they definitely have no credit spreads employed. Because, yeah, that said, they don't have all their calls written, but you can see no insurance. Interesting. But what I wanted to say is you can see you're playing with several different strike prices. To do that yourself, you would either have to have a lot of shares and use a different strike price for each set of 100 shares you have, or if you have a lot of synthetics, you'd have to have a lot of collateral, I guess, to write those synthetics, maybe perhaps margin if your broker is giving that to you, to have so many different strike prices that you can play around with. So it gives you a little, being in the fund, you pay a fee, but it gives you don't have to do it, you don't have to create it yourself, you don't have to track it. For stocks that pay dividends, you definitely don't have to worry about a ex-dividend date hitting you and causing a position to close early that you weren't expecting. And then it also gives you the diversity of different strike prices. You can see how this thing would roll out with different premiums captured at different strike prices and whatnot. But yeah, anyway, jumping into Google. So this is the point where I jump into covering one of these single stock ETFs I now have an in-depth page for. But going over, GOOY is not a very big fund. It's definitely based on the underlying equity of Google, which had been in the penalty box for a while, as far as people thinking that it wasn't going to keep up with AI, or AI was going to eat into its income streams and its market share. But lately, you can see the underlying equity price has shot up. From a comparison perspective, you can see as really recently, Google was flat, but then all of a sudden it sparked up with its latest earnings report. From a distribution per share, they also just had their highest distribution, which is, I guess, somewhat surprising because the ETF price isn't near where it started at 20, but the recent distribution of nearly 70 cents was definitely very good when you consider the average is only 40 cents since the inception date. But then from a price plus cumulative distribution, starting off with $2,000, you can see over the inception date, if you've been just hanging around where your initial investment was, basically your cumulative dividend's been going up, but the ETF price basically went from 20 and then all the way down to 12, but recently has shot up to 14. And your cumulative dividend's up to 10. So on a total return basis, yeah, you're up 10 plus 14, 35, or almost to that 25 point. So 25 on a 20 start, or about a 25% return. For those that do back of the head math relatively quickly, we can see this from an all variables perspective. Here's your total return in purple. And then boom, all of a sudden recently went from just about even on your money over the entire time span as of late April to almost up to 24.88. So a lot of that driven, of course, your dividend keeps rising, but mainly the underlying ETF has been rising based on a increasing Google underlying equity move. And then diving in depth, for those who are looking to know more about this position, it's not a very complicated position. They got a synthetic, they got 2 calls written, 2 calls bought. You can see the stock price as of right now, it's about 250. So it is actually above, this dotted line is probably as of this morning. It looks like it's up $8 basically today. So it's up into the 250 range. So we've gone past the 2 calls that have been sold at 245 and 247.50. So clearly I would expect because of that, your GOY is underperforming Google because we got some capped upside. That said, if we can run past this week, 257.50, then the GOY YieldMax ETF will basically perform line in line with the Google underlying equity. So since it's only Monday, somebody that's owning this fund probably just hope that it keeps running higher. That's a pretty good move for one day for Google. From a fund makeup perspective, I got the fund makeup overall then on a per share basis. It was $1.31 in synthetic value, but currently with the rise in Google underlying equity, this synthetic value will increase. And then as far as what I just showed, I showed their positions, but they are using a 100% credit spread method. So every call that they have sold, they have one bought at a higher strike price, which ensures, of course, that if the Google underlying stock runs too much, they don't lose out on all the upside. They start capturing it at a certain point again, which is probably my preferred method. That's why, and this is a method that they usually use, which is why Misty kind of surprised me, because usually they got some sort of credit spread method employed. But yeah, overall, I don't got a lot of data on GOOY, so I won't look at the positioning over time. But that's Google for those who've invested in it. And then a quick overview of, I also added some data for Microsoft. Got to remember where Microsoft is, Group C. So Microsoft, or MSFO, is the YieldMax fund. Overall, $2,000 investment. Microsoft, you're at $3,161. YieldMax, no reinvestment. Sorry, is $2,900. With reinvestment, you're about $3,100. This one's actually one where with YieldMax, assuming you got the drip feature on your brokerage enabled, where every MSFO dividend goes into just buying more MSFO shares. You can see that overall, the reinvested dividends is actually trailing the underlying equity pretty solid. Early on, the reinvested dividend approach for YieldMax one was actually doing better, but then recently, with the solid Microsoft underlying stock performance, the underlying equity is actually the best performer, but pretty close between these three scenarios. From a distribution perspective, the distributions were pretty good early on, go up and down. Let's see, the average is about 47 cents a share. The recent one is 31 cents. So below the average, but it goes up and down. From a price plus cumulative distribution perspective, we're sitting pretty good. Starting off at 20, we're at 18.20 is the ETF price as of the last, or excuse me, I don't have all the dates selected. 17.59 is the ETF price as of the last distribution, and cumulative dividends are at $11.47 inception date. If you go to the all VARs here, you can get the exact calculation, the total return. Cumulative dividend plus ETF price is $28.94. And then jumping into this stock or this ETF in depth, looking at just from let's see, I want to look at the, market cap and shares. Not a lot of movement in this one, just steady upward trend in both shares outstanding and market cap. This is only like over 140 million. It's not a pretty small fund. As a result, the structure of it's pretty simple. You got your synthetic right here at 500. You got some calls sold at 512.50 and 515. Looks like we're just going over 512.50. So we've hit the capped upside. If it keeps going, we'll get capped again. So a portion of our positions are already capped on the upside. That said, we do got credit spreads. We got calls bought at 522.50 and 525. If Microsoft were to really run past that, we start capturing upside again. But the fund and Microsoft are trading similar at the moment, as we've just hit this capped upside. If Microsoft continues to go higher, I would expect Microsoft underlying stock to outperform MSFO into the end of the week. From a fund makeup perspective, on a per share basis, the synthetics got some value. This will increase, of course, reflecting today's up day slightly. And from a usage perspective, once again, we got, for every call that we have sold, we have a call bought, so we got 100% insurance. And then here's just a look at some of these different metrics shown here. I should say on a fund makeup per share basis. I like to track the cash and ETF price, which is the blue line is cash. ETF price is, of course, the stock price of the ETF. And then the synthetic here is in pink, and the weekly calls that are sold is here in yellow. The yellow line should always basically be negative. This reflects the income that's taken in on a weekly basis. Basically, they take in on a per share basis. So they take it in, and if the contracts go to zero, basically it goes from like a negative 20 cents here. You can see that's a negative 4 cents and virtually to zero. The synthetic will go up and down with the underlying ETF. When you see times where the cash really increases and the ETF price increases, that usually means that they are cashing in their synthetic, or their synthetic made a lot of money and they cashed it in. So they took the synthetic to a higher strike price. But in doing that, they took in a lot of cash, which made their cash buffer go up. And then you also see times where the cash amount will go down. That's either restructuring the synthetic, buying back some of the weekly calls, or paying the same distribution on a weekly basis or a monthly basis. But yeah, that's MSFO and Google in depth. I'll keep updating those for those of you who like to follow the components. But thanks for tuning in.